Today's webinar will be an in-depth review of household and income eligibility rules for premium tax credits and Medicaid. Today's presenters here at the Center on Budget and Policy Priorities are Tara Straw, Senior Policy Analyst, and Shelby Gonzales, Director of Immigration Policy. And with that, I'll turn it over to Tara.
Thank you, Ina. All right, so today we're going to dive into household size and income. So let's remind ourselves why these two things matter. And if you've been doing enrollment assistance for a while, you're very familiar with this calculation. The federal poverty line calculation is really important in determining eligibility for programs. If someone has income below 138% of FPL in a Medicaid expansion state, then they'll be eligible for Medicaid. If income is above that level or above 100% FPL in a non-expansion state, up to 400% of the federal poverty line, someone may be eligible for premium tax credits. To get the federal poverty line calculation, we need to know the number of individuals in a household and the income of household members. So these rules that we'll talk today will help you determine both of those things. And here is a table that shows you the expected premium contributions by income. So you can see that for someone who is at the lower end of the scale, a single person can be expected to pay about $42 a month toward premiums. And a person who is at the top of the scale and is single can expect to pay upwards of $400 a month. And we'll talk in more detail in the next webinar about the premium tax credit calculation, and that will cover how much people pay toward the cost of their coverage. I also want to point you to this resource that we have that I know many of you use and find very useful, that has all of these numbers on it. And so it's a quick reference guide to both the information you may need for open enrollment, but also on page 2 of this resource is the information you may need if you are helping people through the tax filing and reconciliation process. So we'll dive into tax filing status and why this matters. Just to give you a very brief overview, and you don't need to know all of this, there are 5 different tax status options. And you may need to know this for some of the questions that can be deceptively simple in the application. So the application may ask if someone is married. Well, under tax rules, what does it mean to be married? So we're going to go over these definitions very briefly and hopefully give you some tips that will help you answer those considered simple questions. So first, a person is single if they are unmarried. And by unmarried, we mean unmarried. We don't mean that the person doesn't live with their spouse, or they can't find their spouse, or any of those kinds of scenarios. We mean they are actually unmarried or legally separated or divorced. So somewhere in there, a lawyer was probably involved to get unmarried if you were at some point married. Next is married filing jointly. This is a person who is legally married, whether they're living with or apart from their spouse, and they file taxes together with their spouse. And this is one of the requirements to claim a premium tax credit among people who are married, that they have to file jointly. Next is married filing separately. And this is a person who's legally married, whether they're living together or apart from their spouse, and they file taxes separately. Next is head of household, and it's a person who's unmarried or, quote, considered unmarried, and we'll talk a little bit more about that. Pays half the cost of keeping up the home for a qualifying person whom he or she will claim as a dependent. And then finally, a qualifying widower with a dependent child. This doesn't really come into play for the premium or for the purpose of premium tax credits, but that's a person who has a spouse who's passed away in the previous 2 tax years, has a child who meets the definition of qualifying child and pays more than half the cost of keeping up the home for that child. Marital status matters in receiving premium tax credits. It does not matter for the purpose of Medicaid, except in calculating a little bit in who's in the household, but it's not a disqualifying factor for Medicaid, whereas it may be for premium tax credits. In general, a person who is married has to file jointly with their spouse to be eligible for a premium tax credit, but there are some exceptions. One is head of household, and there are questions in the application, new last year, that will walk through the tax test for head of household without requiring a workaround that people have had to use in the past. There are also exceptions for people who have been subject to domestic abuse and people who are, quote, abandoned spouses. There's also a caveat here that be aware that some married immigrants who file Form 1040-NR, non-resident, cannot file jointly. The form just doesn't let them do it, and therefore they might not be eligible for premium tax credits. And this is, again, something that we'll address in the premium tax credit webinar. So looking briefly at head of household, a married person can claim to be unmarried on the application if they qualify as head of household. And we'll go through the test briefly, but unlike in previous years, we don't need to go into it in as much detail because now, finally, the healthcare.gov application is asking the correct questions to get you to the right answer. But a married person can be, quote, considered unmarried and eligible to file as head of household instead of married filing separately if they can answer yes to the following questions. Will you file separately from your spouse? Will you live apart from your spouse from July 1st to December 31st? Now remember, this is a projection, so it's, it can be quite hard to do. But when we say July 1st to December 31st, we're looking ahead. So we would be looking to July 1st, 2021. Will you pay more than half the cost of keeping up the home? Is yours the main home of your child, stepchild, or foster child for more than half the year? And are you eligible to claim the child as a dependent? There are some extra bells and whistles, as there always are on these tax items. But let's walk through an example, or let's first look at the tax household questions. You'll see that they follow this test in the application. And again, this is the healthcare.gov application. So if you are in a state-based marketplace, you may want to keep that list of head of household questions handy because I don't know that every state has adopted these new questions. So first, as the test asks, they'll ask if the person is filing a joint federal income tax return with their spouse, if they're filing at all, if they'll claim a dependent. They'll ask where everyone lives to determine that the child lives with, in this case, Jane, that John lives separately. And then, so there are a lot of address questions to be answered here. And then they'll finally get to the question about asking whether the prospective enrollee will file as head of household. And many people know this because some people file as head of household every year. And so that's maybe not such a difficult question. But if it is a hard question, you can use some of these tests to get to the right answer. So here's an example with Marissa and Amelie. Marissa lives separately from her husband, but is not yet divorced. They will not file taxes together or live together at any point in 2021. Amelie is Marissa's teenage daughter. Amelie lives with Marissa during the school year and with her father during the summer. And so here are the questions that we would ask of Marissa to find out if she can file as head of household instead of as married filing separately, which is a disqualifying filing status for the purpose of premium tax credits. And when we ask all of these questions, we find out that she would qualify as head of household because the IRS would consider her unmarried, and considered unmarried is actually the IRS term for this kind of this version of head of household. Even if Marissa indicates that she's married, but she's not filing taxes with her spouse, she should be determined eligible for a premium tax credit, assuming that all other tests are met. So if the application is spitting out a response that she's not eligible, you may want to go back and double check those questions. There are some other exceptions to the joint filing requirement for premium tax credits. A married person can claim to be unmarried in the marketplace application under either of these circumstances. And this applies not just to, this rule applies not just to healthcare.gov, but it would apply to state-based marketplaces as well. This is an IRS rule for the premium tax credit. You can see at the right, there is a box that is the help text of healthcare.gov. So this may vary by state-based marketplaces, but the rule in general is the same across the country. Those circumstances where someone who is married can claim to be unmarried are domestic abuse and abandoned spouse. So domestic abuse, a taxpayer who is married filing separately can meet this PTC requirement if they live apart from their spouse and if they're unable to file a joint return because of domestic abuse. And an abandoned spouse is one that lives apart from their spouse and is unable to locate their spouse after using reasonable diligence. And so under these exceptions, people who would normally file taxes as married filing separately would qualify to say that they are single. And so that's how it's referred to in the help text. If you go down to the bolded section is a victim of domestic violence or spousal abandonment, you can see that even if they are married, they can say that they are single. So that is a workaround, but now it's a workaround that's actually documented in the help text. So next we're going to talk about determining households for premium tax credits. And I want to give you a big warning here, a big flashing caution sign, which is that we're going to talk about this first because we want to go over the tax rules for who is a dependent, because we know that the application asks you questions like, you know, who are this person's dependents. But remember that when the marketplace application considers eligibility, they start with considering Medicaid eligibility. And Medicaid has some special wrinkles in who is in a household. And Shelby is going to talk about those in a few minutes, but we want to lay the groundwork of determining who is a dependent first, because those definitions come into play when you're looking at Medicaid household eligibility. So there's a bit of a switcheroo here. We are going a little bit out of sequence of how you would actually make these determinations as you go through the application. And of course, the application is going to do a lot of heavy lifting here in making these decisions. But it's just important for you to understand when you get the eligibility determination notice, how the program got where it got, so you can help explain it to consumers. So a household is an individual's tax unit, and that means the taxpayer themselves, their spouse, and any tax dependents. And a household will include all individuals who are in the tax unit, even if they're ineligible for a premium tax credit. So we really do mean the whole family, even if they're not getting a premium tax credit or have some other source of insurance. And we're looking at expected tax filing status. And so, you know, we know that unfortunately, we don't have a crystal ball and we can't know for sure all the time who is going to be in a tax filing household by the end of the year, but we just need to do our best to come up with the expected filing status. And here are the rules for who is a qualifying child. There are basically two types of dependents, a qualifying child and a qualifying relative. A qualifying child can include the taxpayer's child, stepchild, adopted child, brother, sister, niece, nephew, grandchild. So we're looking at more than just the, you know, the actual child of the taxpayer. And here are the general tax rules. The person has to be a US citizen or resident of, for tax purposes of the United States, Canada, or Mexico. They have to live with the tax filer for more than half the year. They have to be under age 19 at the end of the year, or 25 if a full-time student, or any age if disabled. And the child can't provide more than half of their own support. So again, I just want to flag that even though someone may be a tax dependent as a qualifying child, there might be special rules for people who are nieces and nephews, etc., or grandchildren under Medicaid. And so just a big red flag there. There are special rules for children of divorced or separated parents. In general, the parent who claims the child as a tax dependent will claim the premium tax credit for the child. Usually this is the custodial parent. If the custodial parent claims the child on the tax return, they claim the PTC. And this is true even if the non-custodial parent is legally responsible for insuring the child. So if the child lives with mom and is mom's tax dependent, dad, divorced dad may still have an obligation to insure the child, but that doesn't mean he can claim the PTC. The exception would be below. If the custodial parent signs a tax form that grants the non-custodial parent the child's exemption, they can claim the PTC. So there's an actual tax form. It's not that the parents can just say, oh yeah, I think I'll claim them. It's a more formal process than that. So just be aware of that. If people are trying to get a little creative as you talk to them, you can just, you don't have to cite the form, but you can just say, there's an actual process for this under taxes, and so they need to be aware. Here's the second type of dependent called a qualifying relative. In general, this person can be an actual relative, or they can be a full-time member of the tax filer's household who is not a relative. So that might mean, for instance, a tax filer's boyfriend could be a dependent if all of these conditions are met. So the first condition is they can't be a child of someone else. They have to be, again, like in the first definition, they have to be a US citizen or resident of the United States, Canada, or Mexico. They have to receive more than 50% of their support from the tax filer. So the tax filer really needs to be supporting them. They have to be either related to the tax filer or live in the tax filer's home all year. So that person who is not a relative, you can still live with the tax filer 365 days of the year. And the prospective dependent needs to have gross income of less than $4,300. So you can see this is a really strict test. It's intended to be that way, but just keep that in mind. So here's an example. This is Jane, and she's 27 years old. She lives with her parents rent-free. Lucky Jane. She works as an unpaid intern and has no earnings. And so the first test we would do is to ask if Jane can be a qualifying child. We just start there because it's a more generous test. And we find out that no, she doesn't meet one of the standards because she's too old. And so in this case, she would not be a qualifying child, but there's a possibility she could be a qualifying relative. And so we go through that test. And we find out that yes, she meets all of the requirements to be a qualifying relative because there is no age test for a qualifying relative. Let's look at a different example. This is Jay and Kim. They live together in North Carolina. They're not married. Kim earns $24,000 a year. Jay is a musician and earns $3,500 a year. So the question is whether Jay can be claimed as a qualifying relative. We know he's not a qualifying child of Kim, so we skip straight to the relative test. And we find out that yes, in this case, Jay can be a qualifying relative. So as you go through the application, you might find that Jay is a dependent of Kim and that his eligibility for premium tax credits will include Kim in the household. Now, there's a wrinkle here. Again, going back to the Medicaid rules, and first you need to determine if Jay is Medicaid eligible, but we'll save that for Shelby's presentation. which is right now. Shelby, we're going to turn this over to Shelby.
I was like, that was magical transition. Thanks, Tara. Hi, everybody. It's really great to be with you all today here virtually. I hope you all are doing well as can be expected, and I wish you a really, really strong open enrollment season this year. So jumping into determining households for Medicaid. So a few things to think about when you think about households as they apply for Medicaid purposes is that there's one set of rules that's used for individuals whose eligibility is what we like to say it's based off of MAGI rules. In other words, we use modified adjusted gross income rules in order to figure out what their eligibility is. And those rules apply to certain groups of people who get who are eligible for Medicaid. And those groups include groups like children and pregnant women, parents and caretaker relatives, as well as adults, certain adults, I should say. So in states that have expanded Medicaid, we generally talk about that expansion to adults as being the adult group, and that's generally who we're talking about when we talk about adults for the purposes of modified adjusted gross income. Other household and income rules apply to groups that are eligible, and sometimes these folks are adults too. That's why it can get confusing, right? Or they, there's a whole nother set of rules that apply for people who are eligible because of their age, so people who are 65 or over, and for people who are eligible based off the fact that they have a disability. So for those individuals, then a different set of rules applies. So we're going to focus on the modified adjusted gross income rules. So we're going to focus on that first group of people. So, and the reason why is because, as Tara was telling you, when we go through a marketplace eligibility determination, you are first going to be trying to figure out whether or not somebody is eligible for Medicaid or the Children's Health Insurance Program, which also uses modified adjusted gross income rules. And if they're not eligible for those benefit programs, then you can begin looking at whether or not they're eligible for premium tax credits. So these are the puzzle pieces that kind of fit together in thinking about a full eligibility for help paying for health coverage for these folks. So so when we think about how Medicaid looks at households, they kind of separate it into three different categories. The first being for people who are tax filers that are not claimed as a tax dependent by someone else. And I should say that when we talk about who's a tax filer or tax dependent within the world of Medicaid, this is all based off of what they're projected, what they project their tax status is going to be for this year. Okay, so for 2020, they're basically saying, this is how I think I'm going to file taxes. It's not like tied to, well, they did this in 2019, so therefore they're stuck with that forever. That's not how Medicaid's looking at this, okay? So for tax filers, so the first group is tax filers not claimed as tax dependents. The second group is tax dependents, and there are some exceptions, and a lot of people live within those exceptions, so we'll go into those exceptions in more in detail on the next slide. And then the non-filers that are not claimed as tax dependents. So when we think about Medicaid, it's kind of important to think about that everyone's eligibility determination is an individual eligibility determination. So you could actually have members of the same, family that have different household sizes. In some cases, they have different incomes, and oftentimes they'll have different eligibility determinations, for different benefit programs because of these changes or these differences between them. So, and again, as I mentioned beforehand, this is based off of expected filing status. So here's our chart that we usually go through each year, and I believe this is available as well as the following slide as kind of individual kind of resources that I know when I've volunteered to help people enroll in coverage, I use this and I turn to this chart regularly because it can get very complicated. Like Tara mentioned beforehand, and I think it's a really important point that she made, is that generally the application, whether you're coming through a Medicaid route or healthcare.gov or your state's, marketplace, generally this is all stuff that kind of happens behind the scenes, and questions are asked of the individual who's completing the application that kind of gets us through all of these things. But it's super complicated, right? And in some cases you have these seemingly, strange outcomes. So it's important for you all that are helping people to be able to answer questions that might come up. So we do think it's important for you to know these rules because it will help you explain what's happening and why the determination came out the way it is. And also because sometimes things are not perfect, and sometimes a weird, outcome comes up and you can flag it then. And sometimes that's because maybe a question was asked strangely and maybe, was answered incorrectly, or who knows. But those are the kinds of times when it becomes really, really helpful to understand what's going on. So again, the first group that we have is tax filers not claimed as tax dependents. So for those folks, the individual's household is the tax filer themselves. So they count themselves, and all persons that the tax filer or taxpayer expects to claim as a dependent. We'll get to all these other little circumstances at the bottom later because there's a lot. The other big group, like I mentioned, are the tax dependents. And for those folks, the individual's household is the household of the tax filer that's going to claim them as a dependent. But there's all sorts of other, times when that doesn't apply. There's a bunch of exceptions, right? So some of those exceptions might, for these tax dependents, might be because they're a tax dependent that is not the child of the taxpayer. So for example, if I had an aunt that lived with me at my home, she's not my child. Even if she were my dependent, these rules would not apply. I would then use the non-filer, non-dependent rules for her, okay? Another exception is an individual who's under 19 and lives with both parents, but those parents aren't expecting to file a joint tax return, okay? So like, let's say I live with my partner and we have 2 kids together, and we are not married. Those children, or our children, we would use the non-filer, non-dependent rules rather than using one of our tax statuses because one of us is claiming the children. Okay. Individuals under 19 claimed as tax dependents by a non-custodial parent. So that's like a classic example. You could, to give you an idea of when that comes up, is maybe there's a child that lives with grandma, well, grandma is, by a non-custodial parent. I'm sorry, I went to a different example. The individual is under 19, claimed as a tax dependent by a non-custodial parent. So, this might be, I, have a son who lives with me, but his dad lives, someplace else, maybe in Nebraska, and claims him as a tax dependent. So that would be another time. So when that happens, you would use these non-filer, non-dependent rules. Now, there's other times you would also use non-filer, non-dependent rules, right? Like when somebody is not expecting to file taxes, for example, or they're not going to be claimed as a dependent at all, right? As the category would suggest in the name. So so for individuals who are 19 or older, the household is the individual plus, if living with the individual, their spouse, and children under the age of 19, okay? For individuals under the age of 19, the household is the individual plus siblings under 19, parents, including step-parents, and children living with the individual. Like I mentioned before, there's all sorts of exceptions on that slide that we were just looking at that are on the bottom that include things that are really important because they do come up. So there's some rules around how you would count a person who is pregnant, and you know how they would factor into the size. There's some other nuanced rules around ages of children and other things. So it's important to kind of go through those other details as well when you're thinking about how the different circumstances that you're trying to figure out. This summary of Medicaid household rules, I'm not going to walk you through each piece of it, but this was our attempt of thinking about a kind of a flow chart, because we were told by a lot of people that it's really helpful to have this kind of yes, if yes, then, you know, if no, then kind of scenario. So this is just another way to articulate some of the rules that we went over in the previous slide that we think could be really helpful to you. So that might be another resource to look at and then walk through as you're thinking about the different family situations that present to you. Okay, so we're going to go through a few examples. And the first is we have Sonia and Kyla and Diane. And Sonia lives with, and she also supports her mother, who's 60 years old. Her name is Diane, and also her daughter, Kyla. Sonia is a tax filer, and she claims both her mom, Diane, and Kyla as tax dependents. So we look at Sonia first, right? So who's counted in her Medicaid household? She includes herself. She includes her daughter, and she includes her mother, because her mother is her tax dependent and her daughter is her tax dependent, right? And she is a tax filer. So her household is 3. For Kyla, who is the tax dependent, and she lives in the household of her mother, right? There's no exceptions that apply to her. Her household is the same as the tax filer, her mother, who's claiming her. So her household is also 3. For Diane, who is a tax dependent, but one of those exceptions did apply for Diane, right? She is you know, these rules don't apply to her, so instead she needs to go into the non-filer, non-dependent rules, and her household ends up being a household size of 1. Okay, we're going to go through an example now of 2 parents that are living with their 2 children. Their 2 children, Drew and Mary, but these 2 parents are not married. And in this case, we're going to say that Jen, the mother, is going to claim the children as her tax dependents, and then Dan is filing on his own, okay? So for him, for Dan, for both Dan and Jen, they are tax filers, and so for the rules that apply to them, you would count themselves and their spouse and dependents that are on the tax returns. And as we mentioned, Dan does not claim his children as tax dependents. So he is on his own for his tax return. So he is a household of 1. For Jen, she's the tax filer, so she counts herself, and then she also counts her tax dependents, which are her children, Drew and Mary, and her household is 3. Drew and Mary are in that one of those exceptions, right? Their household is, they're going to be based off of the non-filer, non-dependent rules, because they're in that exception that I talked a little bit about, where you have the two parents live in the household with the children, but the parents are not going to be filing taxes jointly. So in this case, when you go through the non-filer, non-dependent rules, you would include the siblings if living in the household, parents living in the household, and also themselves, right? So for each of them, their household size is 4. I'm going to turn it over to Tara to talk about income for premium tax credits and Medicaid.
So first, I think, Ina, do we have time to stop for a few questions?
I think we can take a couple questions that we've gotten so far. So we'll start by going back to the domestic violence, survivors of domestic violence exception. Do individuals who are survivors of domestic violence need to provide any kind of documentation to the marketplace?
Oh, that's a great question. No, they don't need to provide documentation to the marketplace, but it's a tax rule. And like anything with your taxes, you are expected to have some documentation somewhere. And so if the IRS, you don't need to submit it to the IRS, not with your tax return and not any other way. But if the IRS were to ask you, so if you were to be selected for audit or something, it would be helpful for you to have something. Maybe it's a protective order, maybe it's, I don't know, a letter from a shelter, maybe it's a police report. It's okay if you don't have those things. But, you know, I'm just stating the tax rule, which is that, you know, they can ask you to document anything on the off chance, very rare circumstance that you were to be audited. But the broad answer that I want to get across is that no, you don't need to show anything to the marketplace, and in general, you don't need to show anything to the IRS.
If a married person claims to be unmarried for one of the exceptions that you laid out, but they've reconciled come tax time, will they have to, and they're considered married at tax time, will they have to pay back their tax credits?
Not necessarily. If they've, so let's say someone has said that they were single, so they've said that they were not married, and then, but really they were married. They thought they fell into an exception, but they now don't. It depends on how they end up filing their tax return. So if they really did reconcile by the end of the year and decided to file jointly, then that would be A-okay as far as receiving premium tax credits. But if they, let's say they reconciled, but they decided not to file taxes jointly, in that case, the person would lose their eligibility for the exception. And if they filed married filing separately, they may need to repay their premium tax credit up to the repayment cap.
If one person is a citizen and is working outside of the country, would the spouse in the country qualify as a head of household?
Oh, that's such a tricky question. I'm going to defer that question because there are some special rules involved. I will say that if there's a possibility for people to file jointly, even if one spouse is outside of the country, but I'm going to defer that question. And if the person who asked that question could email it to our email address, then I can give you a fuller explanation. But I would want to go back to some tax materials just to make sure I'm not spouting off something that's not quite right.
And we'll provide our email at the end of the presentation.
Tara, can I just ask you a question maybe about that? Is that if in that example the person could be the head of household, then that would be a different circumstance for them. If they could be a head of household, which not everybody in that circumstance could be, then they could proceed in that direction. Is that correct or not?
Yes, and so I mean, in general, you know, maybe I shouldn't dwell too much on the exceptions, but in general, you know, someone could meet the rules for considered unmarried, right? So if they have a dependent who's living with them, they're going to claim the dependent. They are not living with their spouse in the last 6 months of the year. If you go through the test, it's in many cases they could be head of household. I think that there are probably some exceptions, because there are so many exceptions when it comes to immigrants that I would just probably want to give a fuller answer, maybe
Sure.
in an email, or confirm my answer in email. But if you just go through the rules for considered unmarried, I think you do get to a result where most people should be able to, if they have a dependent in the house, which is a big one, then they should be able to claim that they'll be head of household.
Thanks, Tara.
And with the Medicaid households, if there is a 20-year-old college student who works full-time and is claimed by a parent, in the coming tax year, they want to file their own return, but they still receive 30% of their support from the parent. Can that student apply for Medicaid without using the parent's income?
So I'm trying to think of all the different reasons why. I mean, I'm trying to think of the different scenarios. If the person is, from a tax perspective, for you know, it's clear that they would be a tax dependent, right? Because that's one of the pieces that was brought up. But I'm trying to think of how state resident or residency kind of could potentially be factored in. I think that this might be another example of maybe another question that is so specific that we may be better to answer it offline. But in general, you know, there's some restrictions on the Medicaid front in terms of age and how you're counted into the household that can be specified by the state, and how they count certain individuals, if they're a full-time student or not. So it is kind of a lot of different complicated factors to think through. And it sounds like, you know, there's so much specificity in that question. It sounds like it might be based off of real individuals. So it might be helpful to have an offline conversation. If that person could also reach out to me, we can unpack it, because we could factor in what state the person's living in and get a little bit more detail about the circumstances.
Great, thank you both. I'll turn it back to you.
Thank you. So now we're going to talk about income. Modified adjusted gross income, as Shelby referred to it later, we call it MAGI. MAGI is the sum of adjusted gross income, which is on your tax return, non-taxable Social Security benefits. So in some cases, Social Security benefits, some portion of them may be included in AGI, and this provision, this element catches the rest of them, even if they're not taxed. Tax-exempt interest, and excluded foreign income. Now, we're not going to talk about excluded foreign income because it is very complicated, and it involves a lot of tax forms. So we're going to skip that altogether for now. But you add those up and you've got modified adjusted gross income, MAGI. So the big picture, and why we don't spend a ton of time here talking about income, is because it's all taxable, with a few exceptions. And so you should go into income just thinking it's all going to be taxed unless we can find a reason why it isn't. And so examples of taxable income would be wages, salaries, bonuses, self-employment, which is tricky, some Social Security benefits. I said that some are taxed, some are not, all are included. Unemployment compensation, and you know that for 2020, that's going to be one that a lot of people have, and probably going forward into 2021, although that's going to be a tricky projection. Most retirement distributions. So some people, for instance, when they leave jobs, sometimes they cash out their retirement, especially if they had a very low amount in there. Some employers, instead of encouraging you to roll over into a different account, some just write you a check. And people don't know what to do with that check because they don't know where it came from. And so they cash it and they don't realize that they're going to get a tax form at the end of the year that tells them that it's taxable, that it's income that's going to count for the purpose of our MAGI determination. Examples of non-taxable income include veterans benefits. We get a ton of questions about veterans benefits, a ton. It's non-taxable income. TANF payments, child support payments, SSI, which is different from Social Security, workers' compensation, they're all non-taxable. The source that I use when I'm answering questions about income and when I have questions is the publication 525 from the IRS, and it's a really detailed look at what is taxable and what's not taxable. A couple special notes is that pre-tax deductions like retirement contributions, like when you put the money in, are not included in MAGI. It is included in MAGI when you take the money out. Alimony for agreements after January 1st, 2019. Neither spouse can include alimony on the tax return, but people who were divorced prior to that generally do include it on the tax return, but they can choose to adopt this alternative method. Income can come in the form of money, goods, or services, and cash income is taxable, and it's included even if people tell you all of the following. I haven't declared it in the past, it's on the side, it's not my main job, I only work seasonally or occasionally. So all of that, you know, you can tell the enrollee that all of that is really taxable. I totally understand that you're not the tax police. I get that, but if, you know, a lot of people just sincerely don't know that certain kinds of income are taxable, and so you can answer that question for them. If it's, you know, side income, self-employment income, a lot of people, you know, we say self-employed. A lot of people don't consider themselves self-employed. That sounds kind of formal, but, you know, under tax parlance, they would be. We're going to talk very briefly about self-employment, even though it's pretty complicated. Many people, because they don't consider them self-employed and they don't kind of think ahead about what that means for tax purposes, many people don't have a good record of either how much money they made or what their expenses are. So some of the questions that you can ask would be, you know, does the person have regular monthly income? So if they work a particular kind of job, do they do it once a week, every week, to get a certain monthly income or a certain weekly income that you can multiply? If there's no regular income, well, what jobs are lined up for the year? Like, what do you actually know you're going to receive? If you don't have a good projected estimate, you can consider adding or subtracting from the previous year's income if that's available. So, okay, we have no way of knowing what is going to happen in 2021, but what happened in 2020? And is that a good barometer for what might happen in 2021? You can also make estimates by job or by month. For the purpose of preparing tax returns, I've definitely worked with people who have, you know, they've just generally deposited money into a bank account, and so you can look at their bank account and say, okay, you had all of these deposits. Were all of these related to your side employment? And if you estimate income, you can also estimate your expenses and subtract them out before you include that amount in MAGI. So does the person have regular monthly expenses? What kinds of large expenses does the person anticipate? So maybe you don't know all of their little expenses and don't want to get bogged down in that, but is there something, you know, some kind of like capital expense? Like, is there a machine or a piece of equipment they have to purchase? So that could be deductible. What are the person's expenses in the previous year? This is one in particular. It can be hard to, it can be a little harder to measure income in bank records unless they have a separate account for their business. But receipts, debit card records, known cost of supplies, these are things that are a little more, a little easier to find. I have learned over time, and so you can look at those. What types of business expenses are we talking about? We're talking about advertising, legal or professional fees, office supplies, rent, lease, repair of equipment. That tends to be a big one. If it applies at all, that tends to be pretty major. Business meals and entertainment, that's hugely complicated in tax world. So I can't imagine many people will have that in the population we're dealing with. Business mileage can be a big one. That's one that the person is, maybe going to need to do a little more research on with the IRS materials. And we launched this tool last year to help you catalog some of this information, and we have it available on our website. It's a downloadable PDF where you can work with the consumer to estimate some of these things. So it asks about gross income, it asks about, on the other side of this form, it'll ask about expenses. One use for this tool is, if you're doing back of the envelope estimates about all of these things, it can be quite difficult, but it can also be difficult for people to remember. So this is something that they could go out the door, or our metaphorical door with remote enrollment assistance, and have a record of what your final estimation was. And if they have big changes from what you estimated, they can always come back to you and say, we've got to make some changes to my application. I estimated income too high or too low. There's a tricky question about when to count a dependent's income. And of course, there's a pretty complicated IRS test for that. Household income includes the MAGI of the tax filer, but also all dependents who are required to file a tax return. But if the dependent doesn't have a tax filing requirement, none of their income is included. There are special rules for single dependents and married dependents, for dependents who are under age 65 and over age 65. And of course, the IRS is always about a year behind in releasing these things. So we don't know the numbers for 2021. We only know 2020. They don't change much from year to year. But in general, it's going to be quite difficult for someone to have, for a dependent to have income that means that they are required to file a tax return. Since the tax law in 2017, a dependent would need to, in general, have earned income that's more than $12,400. And usually, if a dependent has income that exceeds $12,400, they're probably not a dependent. So, so I would say that's the number to keep in mind. Unearned income is things like, interest on investments and all sorts of things that we just don't see a ton of in our population that we're assisting. And the taxable gross income column there, the third one, is pretty complicated. It's really the earned income that you're going to see, and the number there is quite high. So you should see very few, and fewer than you did, a few years ago, of taxpayers who have a tax dependent who's required to file a tax return. That's becoming a bit of a unicorn. It's important to note, though, if a dependent does have a tax filing requirement, both their taxable and their non-taxable income, like non-taxable Social Security, will be counted toward the household income. So you basically would apply the MAGI definition to the dependent separately, but only if they're required to file a tax return. So here's one example of it, just to put it into context for you. This is Jill and Ryan. Jill is Ryan's mom and claims him as a tax dependent. Jill's income is $25,000. Ryan has a part-time job. He looks like he's about 12 there, but I swear he's old enough to legally work at a part-time job, and he earns $3,000. So whose income is counted? For the purpose of premium tax credits, it's going to be only Jill's income, because he doesn't have income that is high enough to give him a tax filing requirement. His earned income would have to be in excess of $12,400 for him to have a tax filing requirement. So you can see that Ryan and many, many, many other dependents would not meet that standard. Back to Shelby.
Thank you. I'm going to try and go through this pretty quickly because I think we're almost out of time. So we're going to talk a little bit about time periods and how they differ between Medicaid and premium tax credit eligibility. So in general, when we think about Medicaid, we're looking at a person's current monthly income, and for advanced premium tax credits, eligibility is based off of projected annual income for the coverage year. And then, of course, there's an actual that happens, right? So the actual happens at the time of tax filing when a person's annual income is reconciled based off of what really happened, the actual annual income. So that could be tricky, right? Because there's a lot of moving parts, and you know, I kind of simplified it in Medicaid, right? In general, the rule is that you're looking at current monthly income. There are certain rules there's certain rules that are state options that are meant to kind of help smooth out some of those differences. And then there are some requirements depending on whether or not a person is, you know, you're thinking about their eligibility as somebody who's newly enrolling or somebody who is already enrolled and is being redetermined their case. But in this case, we've got an example of Carla, and she lives in Ohio and she works in retail. And in November, she applies for coverage in the marketplace. It's open enrollment, right? And she provides this income information. So her income in November is $1,370, which puts her at 129% of the federal poverty level. She projects that in 2021, her income will be $17,000. And that would put her at 133% of the federal poverty level. Because, you know, as somebody who works in retail, there's going to be certain months where she has, you know, more hours. Like, for example, maybe in back to school time, like now, right? There's an increase in shoppers, and also around the holidays, for example. So the marketplace assesses her eligibility for Medicaid, right? Because the marketplace, based off of the information that she provides, her income being at 129, she's in a state that's expanded Medicaid. They've said this is a person who's likely going to be eligible for Medicaid. So they transfer her case to Medicaid, and you know, as is often the case, these transfers don't happen instantaneously. In this case, she's transferred in late December. Medicaid then asked Carla to provide most recent pay stubs. And, you know, it was the holidays, right? And the holidays, she has more income. So she is not appearing to be eligible for Medicaid based off of this increased income that is, you know, for that current month. So Medicaid is denied and she is sent back to the marketplace. And the, you know, we can imagine what happens then. So you know, we included this notice. Now, we don't know if the notice is going to change this year or not. But what should happen to Carla is when Medicaid says, we're not, you know, it does not appear that you're eligible for Medicaid, Medicaid should send Carla an eligibility notice that explains that she was found ineligible for Medicaid based off of income, and hopefully some additional explanation. And then separately, the marketplace will send a notice that will contain information like this, including some steps that Carla should take to come back to the marketplace to figure out, you know, if she's going to be PTC eligible and to select a plan and all of those steps. As you know, these kind of handoffs can be tricky, and it is helpful to, you know, especially with people who have either income that fluctuates or income that's very close to one of those thresholds, giving them a heads up that these kinds of things sometimes happen, that, you know, the marketplace assumes you're eligible for this. There's always a possibility that Medicaid may have something else in mind when they look at your circumstances more closely, so that people have a heads up and can be at least a seed is planted and they can be on the lookout for additional information. The next section is how marketplaces and Medicaid combine household and income rules to determine eligibility. So in this case, Dan's income is $18,000 a year. He's a household size of 1. I'm going backwards here, and I'm looking at the premium tax credits first. So when we think about annual income, he's at 141% of the federal poverty line, which makes him look like he's going to be eligible for PTCs. Medicaid, there's no difference, right? He's still a household size of 1. Even though this is his monthly income, he's still at 141% of the federal poverty line. So his example is pretty straightforward. Jill, for Medicaid purposes, is a household of 3. In her case, it's going to be the same as well, right? Her household doesn't change between the two different programs. Her household size, I mean, and her income is yes, looked at monthly for Medicaid and annually for premium tax credits. So it doesn't make a difference for her. So her income is at 120% of the federal poverty line, and if she lives in a state that has expanded Medicaid, she would be eligible as an adult. If she is in a state that has not expanded Medicaid, at 120% of the federal poverty line, I doubt that she would be eligible as a parent, because I don't think any state goes up that high for parents, but I could be wrong. There could be an exception. But generally, then, if she's in a state that has not expanded Medicaid, her income is above 100% of the poverty line, so she would be more in the premium tax credit range, with her annual income being $26,000 a year. As we pointed out earlier, Drew and Mary are in a stranger circumstance in that their households size is bigger, right? It's bigger. And in this case, when you look at their Medicaid eligibility, remembering that we're using their household size that includes both parents, well, in their case, you also include both parents' income. So they have their income at 168% of the federal poverty line, because you are adding both parents' income. So their federal poverty line level is higher than each of their parents. And for premium tax credit purposes, they have their income would be the same as Jen's, their mother, because their mother is a tax filer and they're the tax dependent. So they would have the same income eligibility as their mother. In this case, at an income of 168% of the federal poverty line for Medicaid purposes, and as children, they would either be in Medicaid or CHIP, depending on what state they're living in. Okay, now I can't advance. Oh, okay. Ina, I'm going to turn it over to you to talk about the resources.
Thanks, Shelby. So we do have some updated resources available. We'll be sending out the slides with these links to the resources after the presentation is complete. And next slide, please. So as a reminder, we'll be sending out the materials, all of the things that we've covered today, as well as a recording for the presentation. And we'll also post everything to the Beyond the Basics website at healthreformbeyondthebasics.org. The next part of this webinar series is scheduled for next Tuesday, September 22nd at 2 p.m. Eastern, 11 a.m. Pacific. You can register for upcoming webinars on the Beyond the Basics website under Upcoming Webinars. And if you have questions or need assistance, please contact us at beyondthebasics@cbpp.org. And with that, we'll bring today's webinar to a close. Thank you for joining us today.